VinjaGPT.com. Value investing powered by AI.
Welcome back, value investors. Welcome to a new video on our YouTube channel. It has been a while since we published our last video, so actually we have been very busy providing new features and adding new features to VinjaGPT. So today's video is about Nike's latest earnings that they published or reported just a couple of days ago, so around March 20th, 2025. So as always, and of course this will help us, do not forget to subscribe to our YouTube channel. Do not hesitate to comment as well the video and also to like the video. This will help us develop the YouTube channel moving forward. So before we start, also a quick disclaimer. I'm a shareholder of Nike. I'm sharing with you the latest update on my portfolio. So this is an update from March 18th. And on March 18th, actually, 5.21% of my portfolio was linked actually to Nike, the company that we'll be analyzing today. So let's start first with the background around Nike, just to give you a small understanding where Nike stands and why actually a lot of people are looking into Nike as a company. So first of all, I mean, you probably know that Nike has been created by Phil Knight. He was the CEO and founder since 1964, has been CEO until 2004, and has been chairman until 2016, and now has retired actually. You probably know Nike, and if not, I'm giving you an update. So the most known brands of Nike, they actually have three brands that are pretty much known, which is, I mean, the Nike brand with the swoosh by itself, Air Jordan, and Converse. So you see on the left-hand side, you see the three logos that are very well known actually to a lot of people. And those are the three strong brands that Nike has in its product portfolio. So on top of Phil Knight, who has been the long-time CEO for Nike, you actually see here that Nike has had a couple of CEOs in the meantime. So after Phil Knight retired and became chairman, so actually you had William Perez, who only was there for around 2 years, Mark Parker, who was pretty successful for around 14 years, and then John Donahoe, who has actually now left since I think it was in October last year, and has been replaced by Elliott Hill. And I will give you the context about the new CEO and what has happened to John Donahoe actually as CEO. So you see that he was kind of around 4 years, rough cut around 4 years, he was CEO of the company. And you have to put into the context that Nike at that time, so the period that Nike was operating was a period of COVID actually, and Joe Donahoe had I mean, his background is actually a tech background. So he actually took a couple of decisions which were great during COVID, but now actually putting Nike into huge troubles in terms of revenue growth. So the first decision that he took was actually to eliminate categories. So he organized and laid off a lot of people, apparently also people who had redundant functions in the company. And so this actually, he reverted this reorganization in 2023, in fact. So I think the layoffs took place around 2020, 2021, so at the very beginning of his tenure. And so the structure of the product portfolio of Nike in terms of categories was actually reverted to 2023. Second thing, and that's maybe also linked, some people say that this was, let's say, advised by McKinsey. We will never know, of course. Some people consider that this is because John Donahoe was actually a tech executive, that he focused the company, so he focused Nike to become a DTC, so direct-to-consumer-led company, pushing very strongly on the e-commerce activities of Nike, and through that actually kind of no longer supporting the wholesalers of Nike. And we will come back, I will give you a data point how many distribution points Nike has across the world. But I mean, in the US, the typical wholesalers are Foot Locker and Dick's Sporting Goods. And so I think that the relationship was no longer good with them, and Nike was like, we have to focus directly on touching our customers, so we actually will put less efforts into our wholesalers like Foot Locker and Dick's. The problem was that by doing that, I mean, those Foot Locker, I mean, those wholesalers, if it is Foot Locker or Dick's, they have physical surface in their shops. So somebody else is going to take the place if Nike is no longer present. And this actually created issues post-COVID to Nike. And also, they also decided, and this is again, you see the tech influence, this is also the DTC, the direct-to-consumer, let's say, coolness that a lot of, let's say, even consultants and companies try to focus on DTC models over the last couple of years, where actually John Donahoe said, okay, I want to have a centralized marketing, it's going to be data-driven and digitally led, again, with our e-commerce, or let's say website or websites, because they have different sizes, if it's for Converse or Nike, for example. So, and what happened, and I'm going to show you the share price later on, what happened actually to the share performance. I mean, during COVID, it was fantastic because all shops were closed. So obviously, you see that until up to 2022, the share price reached new heights at around $179 a share. But you see what happened afterwards when people went back to stores and again buying through stores. Actually, what happened is that the revenues of Nike started declining, and you see after rough cut 2022, you see that 2023, 2024, and even now 2025, the company has lost around 38% of its market cap or its share price since 2022. And just after they published the last results a couple of days ago, the share price actually lost nearly 6% on the New York Stock Exchange. And we're going to be analyzing as well the company from its fundamentals. But this is to make you understand the background why a lot of people are looking at Nike, and a lot of people are now depressed about Nike, where actually they say, wow, the share price has lost 38%. What is going on with Nike? They are losing traction. They are losing market share against competitors like Adidas, Puma, Hoka on running, for example. So new CEO came in. So see, this is pretty recent, October 14, 2024. And what was interesting as well with Elliott Hill, I'm going to share a little bit what is his strategy. So Phil Knight, the co-founder of Nike, he actually quoted that he was very much looking forward to having Elliott Hill become the new CEO of the company, because Elliott Hill is actually a senior veteran of Nike. The guy started, I think, as an intern and went through all the levels and layers, specifically the sales layer in Nike, up to becoming VP, I think, of consumer brands, if I'm not mistaken. So Phil Knight was actually very positive about Elliott Hill joining the company October 14, 2024. So let's look a little bit about what is Elliott Hill's strategy and a little bit his analysis of the company. So the first thing that I found interesting, there is on YouTube a video from the Fortune magazine that is dated January 23rd, 2025, where, and I'm just highlighting a couple of quotes that Elliott Hill was speaking to the journalist, where he mentioned that Nike has become too promotional, too many discounts between key moments, key retail moments, and I will not put the whole quote here, but he was mentioning in the video, so that he was referring actually to Black Friday and Cyber Monday, where he says it's normal that for Black Friday and Cyber Monday, even a company like Nike provides huge discounts, so that really, because that's normal for those key retail moments, but not the whole time across the whole year. And that was a little bit the criticism that he was expressing versus previous management. So that was one of the, let's say, important quotes that he was mentioning in this video. The second one is that, and I'm smiling at this, at the second one, where he was mentioning that the company was leveraging promotions to drive revenue. And I will not mention in which of my companies I had the same, but at a certain point in time, I saw as well some salespeople actually leveraging promotions just to drive revenue, because maybe the targets were too high or the sales teams were not well trained, and they were just pushing, pushing down the throat of the customers products and services just by using promotions and very aggressive promotions. So I'm smiling because I fully relate to what Elliott Hill is saying, and I fully understand that that's not the right strategy to have. That's not the right sales strategy to have when you actually just grow revenue by putting and pushing for promotions. This will, at a certain point in time, this will fire back. And this is actually what happened to Nike. So those are two first interesting quotes on his analysis after he joined as a CEO, Nike. Then as well, so now looking a little bit at what are the things that he intends to do, in fact. So what is clear, and you're going to see this later on as well, I have a slide where that is coming actually of the latest analyst call. What is clear what he is saying, and I'm showing you here the latest ad from Nike. He says that, I mean, the core DNA of Nike is sport and the athletes. And he feels that what Nike has lost, so when Nike has lost its mojo, is no longer celebrating and focusing on athletes. And I mean, this advertising campaign, I find it's a beautiful one. It's also very inclusive of women, which I think is great. And it's about women being told that you will not win, and actually they have become super performant athletes. And Nike is really focusing now on athletes and celebrating the athletes. This is one example of a new campaign that is running on YouTube. You see here it says, "You can't win, so win." And I really think it's a very, very strong campaign. So you feel already after just a couple of months, let's say the signature of Elliott Hill as CEO of Nike, and he's trying to push actually the company to focus on the athletes. And when I summarize what he has been mentioning and repeating since he started in October 2024 as a CEO, so what he tried to clarify is what is now the focus of Nike. First of all, he has been repeating this very often, that the focus and the strategy of Nike is on three things. First of all, there are 5 fields of play. So the sports that they're going to focus on is running, basketball, training, football, and sportswear. And you're going to see actually why running, amongst others, and basketball are important when I'm going to show you the product revenue. And you're going to see actually how much footwear actually represents in the revenues of Nike, which is actually a lot. And then they also now focus on 3 key countries, which are the US, China, and the UK. You're going to see as well this later on. I'm showing you the latest from the latest financial reports. I'm showing you the geographical distribution of revenue sources. And then also on 5 key cities, so New York, LA, London, Beijing, and Shanghai. You're going to see that China is also an important market to Nike as well. So his focus is, I mean, you see clearly the signature of what he wants to have as a company. So he wants to have this winning culture, really shaping the brand. You're going to see actually also in the financial reports, in the income statement, that they have been spending now much more money on brand recognition, in fact. So the product portfolio already discussed with the 5 fields of play, which are really key to the new CEO. Elevate and grow the marketplace and win on the ground. So actually one of the very important things that the new CEO is now hopefully and successfully bringing back to Nike is talking to the wholesalers, talking to the distribution channel, right? So what he's clear about is that he cannot win, and Nike cannot win alone only through DTC, so direct to consumer strategy. But it is really important that they restore a sales organization, that they create joint plans where the wholesalers partner with Nike, and that they have plans that are built together. And this reminds me, when I was running Microsoft in Luxembourg as well, that partners were actually one of the key assets that we had, that competitors, for example, like Amazon, did not have. They were very weak actually on the partner channel, and this is an asset that Microsoft has always had. So I definitely understand what the guy is saying here. So Elliott Hill, the new CEO, that he wants actually to reuse the power of the partners that they have. And this, of course, includes the Foot Lockers and the Dick's Sporting Goods. And just to give you a sense, they have around 40,000 distribution points across the world in 190 countries. Of course, those are not all and by a mile, those are not stores that are owned by Nike. Nike owns the premium stores, like Apple would do it, like Microsoft would do it. But those are actually points of distribution that are owned or franchised by some wholesalers actually. So yeah, and I mean, before I go into the analysis, just one thing. Of course, I mean, I'm doing, together with the VinGPT team, we're doing on this YouTube channel a lot of company analysis. And of course, if you want to access and do your own analysis, you can access Vinch by going on, you have the links here either on vingpt.com or bit.ly/Vinch, or you can even scan the QR code, and this will bring you directly on the OpenAI store to VinchGPT. So this is the value investing GPT that we have created for value investors, and that it is powered by the OpenAI engine with our own curated knowledge. Right, let's go now into the company analysis, and of course I'm going to show you as well how Vinci GPT is looking at the company analysis. So the first thing that I would like just to share with you is, first of all, is Nike part of the top 100 brands in the world? And actually Nike, yes, they are part of the top 100 brands in the world. So actually when you ask Vinci GPT, you see the prompt here, do you have Nike in your top brands? It's replying actually with the latest December 2024 figures, and we use for that Interbrand currently. So the public report of Interbrand. So you see that actually Nike is represented twice in the top 100 brands in the world. The first one is on position 14 out of the top 100. So that's pretty strong positioning. And the second one is Air Jordan. So remember that Nike has three strong brands: Nike, Air Jordan and Converse, and Air Jordan is also now has entered the top 100 at position 99. What I asked Vinci as well is, how has the Nike brand evolved since 2015? And I mean, the brand value has increased a lot, right? And I mean, for the accountants and the corporate finance specialists in the room, you can look at the amount of intangible assets that Nike carries in its balance sheet. It's, I think, 45 million. And here we are speaking about 45 billion. So that's a massive difference, which has an impact on the book value of the company. What is interesting nonetheless, when you look, because we have 13 years of top 100 brands in the world in Vinci GPT, so that's part of the curated data points that we have added to Vinci GPT. So you see actually that the brand value came down a little bit, specifically in 2024. So this is typically what you see it also on the share price. So you see that even a brand agency like Interbrand considers that Nike has lost a couple of positions on its brand position, and also its brand value has lost around $8 billion US. So we're going to see in 2025 how this will, of course, further develop. Now, let's look at the revenue. So I'm using now, you see here, this is 3 months ended. So this is the latest quarterly report that has been presented a couple of days ago. So it shows the quarter ending end of February 2025. And I think the analyst call was March 20th, 2025. So it's just a couple of days ago. So what is interesting, first of all, and this is important to understand where the revenues of Nike are coming from. So you see actually that the revenues, 69%, are actually coming from footwear. So this is, and probably you now understand why Elliott Hill is focusing on those 5 fields of play, which include running amongst others and basketball amongst others. You see that apparel, so that's clothes and everything that is related, that represents 27%, and equipment is pretty small actually. There is just a couple of hundred of millions on the total amount of the quarter. So that in the quarter they made 10 billion or nearly 11 billion US dollars, but it's around 9% less than when you compare quarter over quarter with 12 months ago, the same quarter. From a geography perspective, I mentioned to you, and now relating to the strategy of Elliott Hill, where he is focusing on 3 countries. If you remember, it's the US, it's China, it's the UK, and 5 key cities. So we have New York, LA, we have London, Shanghai, and Beijing. So you see that in North America, so that North America contributes to 42% of the revenue. So that's the home market. And as I always say, companies, in order to be strong, you need to be strong in your home market, first of all, and from there actually build up outside. EMEA represents 27%, so of course this includes UK. And then you see that Greater China alone, which includes probably China and Taiwan, actually around 15% of the total revenue. So you see that you understand why Elliott Hill is focusing on the US, is focusing on China, and is focusing as well on what I was showing on this previous slide, is focusing a lot on those 5 fields of play, which include running amongst others and basketball, because this is linked to footwear revenue actually. And so what I've been asking Vinci as well is to perform a fundamental analysis. I'm going to be running the video here. So I mean, for those who know Vinci, so I mean, this is a start screen. You have conversation starters like it would be ChatGPT, but it's our GPT, but it's only using the OpenAI engine below, but it's using our own knowledge and our own data points. So first of all, I'm asking Vinci if it has Nike in the companies. It says yes, it has it, and you see that it has it. And I mean, you see the industry, footwear and accessories, and the exchange is the New York Stock Exchange. And I'm asking actually Vinci to perform a fundamental analysis, which for those who did the other value investing training, you know this as a level 1 analysis as well, but you can prompt Vinci just by prompting it to perform a fundamental analysis. So you know from those tests that first of all we are looking at PE and price to free cash flow to be below 15. It's actually with the current share price pretty close to those undervaluation relative figures. You see also from a passive income perspective, of course, the dividend yield is increasing because the share price is going down. You see that the dividend payout ratio, let me just stop here one second the video. You see here on bullet point number 2, you see actually that, so the dividend yield is increasing because the share price, if you would buy now, is actually being reduced. So they pay around 40 cents per quarter of a cash dividend. The dividend payout ratio is very good actually, so they have the opportunity to continue paying out those cash dividends. And what is interesting as well, and this is new in VinGPT since a couple of weeks, you also have now the share buyback yield. So you see that actually Nike is buying back shares, and you're going to see this later on in the income statement. They have been buying around 4% of shares. So basically, when you look at the total return to shareholders, it's close to 7.5% on Nike. In terms of solvency test, that's something, of course, that we have trained Vinj as well. I mean, the debt to equity is pretty moderate at 1.7. The cash debt ratio, they have a lot of cash. I'm going to show this to you in the latest financials. The Altman Z-score, that's for more advanced corporate finance specialists, but the Elements Z-score is a bankruptcy indication metric, and it shows actually that. And when you look at the balance sheet, except that the figures would be wrong in the balance sheet, but then we have a problem with the auditor. But actually, Nike will not go bankrupt tomorrow. The interest coverage ratio, it's negative here because they do have more income than expenses on their debt. On profitability and capital efficiency, they actually have a pretty good return on invested capital. So they have always been very good at that. Return on assets is pretty decent as well. And it's a company that doesn't have a lot. I mean, they don't have huge supply chains. So compared to automotive industry, and they don't have warranties, those type of things. So it's very low in terms of capital intensity, which is something that I like, and you remember that I've learned this from Warren Buffett, that it's of course better to have companies that have high ROICs, high return on assets, but at the same time that have reinvestment levels, so they have capex levels to profit that are low, because this allows the company to have money available to, for example, increase their market share and spend more on marketing because the capital intensity is low, for example. So what is interesting as well is, of course, after having analyzed the fundamental analysis of the company, is actually to calculate the intrinsic value of the company. And what you see here, let me just run the video. So I asked Vinj to calculate the intrinsic value just with the default values. And what I asked Vinj as well, let me just run the video here. I actually am asking Vinj, after having performed the intrinsic value calculation on 3 methods, dividend discount model, discounted cash flow, and discounted future earnings. And because I've had students and investors who ask me when they have seen that I've been continuously investing into Nike, they were doing the analysis with Vinj, but just with the default values of 3% growth rate and the cost of capital of the industry. But for me, my cost of capital is 7%, and I consider that over the next 30 years, that Nike has a reasonable growth rate of 5% instead of 3%. So this is my sensitivity analysis, and I'm asking Vinj as well, you see it in the prompt, I'm asking it to show it side by side, so the previous intrinsic valuation that it has been doing with the new one that I've been asking. And you see actually, let me show, yeah, exactly here with the mouse, you see actually that with that's my way of analyzing Nike. I mean, this is not now a solicitation for you to go and buy the company. I'm just transparently sharing how I do the analysis of companies. So actually, Vinj is telling me that the share price, so the intrinsic value of the company is rough cut between 74 and 84. And last Friday, the share price was between 66 and 67 US dollars, which means that the market was giving me Nike at an undervalued share price, which is for me, again, with a dividend yield that is pretty fair, so 2.5% on cash dividends and rough cut 4% on share buybacks. This is for me, and I will continue doing cost averaging. Again, this is not a solicitation for you to buy. But I like Nike. I like what the new CEO intends to do. I clearly understand his strategy, and I think he's right on what he intends to do. I don't know if he will be succeeding, but Nike for me is a company from a solvency perspective that will not go bankrupt. So if the market is giving me currently at this type of share prices, at this level of share prices, for me, it's I'm gonna be continuing to spend money on Nike and increase my portfolio on Nike. But again, this is not a solicitation for you to do it. I'm just sharing how I do it. So let's look also now at the financials, because I mean, as a serious investor, and I'm sorry for those who hate financial reports, but not later than last week I was discussing with one of our users on the VinceGPT community. Yes, I can remind you that we do have a Discord community. Just go on vingpt.com and you're going to see the link to the Discord community. So it's important that you analyze the balance sheet and the income statement and the cash flow statement. So the cash flow statement has not come out yet. It will come out next week because they have not published that 10Q report yet. But they published already the consolidated balance sheet for the last quarter and the income statement. So I'm already showing you those two financial reports. So the first thing what is interesting and something that I like is that the inventories are coming down. So I think that's it. That is good. So I hate when companies actually, when they have a lot of, when they are a little bit in a difficult situation, when inventories are actually growing, that's never a good sign. So it's good that it means that they're actually taking inventory and converting the inventory into cash probably, or into accounts receivable. So this is sold, but the supplier, or let's say the customer, has not paid yet. The accounts receivable, that's a typical sign of earnings manipulation when they grow like crazy, because this could mean that actually the company is pushing really a lot discounts to the customers, and the customers have not paid. And a way of not paying and how accounts receivable grow is because payment terms become bigger. So I don't know what the Nike payment terms are. I would need to read the latest financial annual report. But if they would go from 30 to 60 days, well, typically then the accounts receivable grow. So this is never good in terms of financial health when the accounts receivable grow and inventories grow. So this is good. You see that the cash and cash equivalents position and the short-term investments, are going to put those two together. They are rough cut. This has not changed. So they have not destroyed a lot of cash. They have a lot of cash available. And then, of course, something that I like to look into is how much cash and short-term investments do they have compared to their long-term and short-term debt. So you see actually on bullet point number 2 that their long-term debt has decreased by $1 billion, but actually it's because now in the last quarter, $1 billion had probably to be repaid as debt, so the debt remains rough cut constant at around $8.9 billion. And actually, just look at the amount of cash that they have in short-term investments. They have more cash and short-term investments than short-term and long-term debt. I mean, the company will not go bankrupt, right? So, I will show you also how to look at interest coverage ratio, but the company will not go bankrupt. They have really very low levels of debt. The shareholder equity is at 14,000, so they even have debt to equity where the equity is higher. So this is very strong. The equity remains constant as well. So, I mean, the balance sheet looks definitely very, very solid. Property, plant, and equipment has decreased a little bit, but they have not now done. You see goodwill and intangible assets. So this was the rough cut 500 million that I was sharing earlier. When you look here, let me just go back. Yes, here. So actually, you have companies where the brand valuation is very close to what they carry in terms of intangible assets in their balance sheet. And here actually, so if you would do a relative valuation on price to book, you would have to do an adjusted price to book. The price to book of Nike is very low. Why? Because the price to book unadjusted is around 6.8. When you look here at the amount of intangible assets, sorry, let me just go back one. Yeah, here. You see actually that they don't carry those 45 billion that Interbrand values the Nike brand. So they only carry, and this is very conservative and very defensive. I do like this. So again, I like how Nike is actually, the financial teams are running the company as well. So they are very prudent on intangible assets. There is nothing on intangible assets, but the Nike brand is worth much more than 250 million of US dollars, right? So this also tells me that the price to book of 6 is actually not correct, and there has to be an adjusted price to book calculation to be done. So the price to book is actually very, very, very close to 1, in fact. So income statement analysis. So here you see the latest income statement. What is interesting as well, I mean, you of course see that the revenues have been declining. You see that the profit has been declining as well. What is interesting is on bullet point number 1, and this is linked to what Elliott Hill was mentioning, you see that actually they have been spending more money, so rough cut 80 million more on demand creation. So this is typical, let's call it a marketing expense. And that's definitely something that I like, because I think that Nike has to come back. I mean, like the YouTube advertising that you saw, you can't win, so win. I mean, of course, they have now to be present. They have to earn brain time of customers, of consumers, of people who maybe went away to other companies. So this is definitely something where you're going to see that, I mean, the cost will increase in terms of marketing, but I like that actually. So that's for me a positive sign that they're spending more on marketing. One thing that I wanted to mention as well, you see actually here why the interest coverage ratio is negative in the previous analysis of VingeGPT, because actually they have a interest income that is so they have, so net they earn more money on their short-term investments versus the interest on their debt. So they will not go bankrupt. That's as easy as that is what it means. And what is interesting as well here, if you see my mouse moving, when you look at the amount of shares outstanding, you actually see, compared to 12 months ago, that the amount of shares has been been reduced by around 4%. So by that, technically, your book value of the company has increased by 4% if you were a shareholder in 2024. So, and this is something that Vinge was showing in the fundamental analysis. Vinge was saying that the share buyback yield trading 12 months was 4.29%. Well, this is linked to this, because the amount of shares has been decreased by 46 million. The amount of shares, I mean here, so it's a count of shares, not an absolute number. So I mean, from an income statement perspective, the company is also, of course, the revenue is decreasing and people are depressed about this and they sell their shares of Nike. Well, I have to be honest, I think for me at least that Nike is cheap. So for me, I'm not selling my shares of Nike. It's the other way around. I'm actually buying more of it. But okay, that's my decision. Again, not a solicitation for you to buy. So one of the things that I also like always to do is I like to compare what VingeGPT on the left-hand side is sharing in terms of intrinsic value calculation, and just making a small test with Morningstar on the right-hand side. And actually Morningstar as well is mentioning that, so what they call the 5-star price. The 5-star price is the level of share price where the company starts getting cheap. They do confirm what, at least from my assumptions, what I'm looking at VingeGPT. So according to Morningstar, they consider that Nike is trading at a 39% discount. It's even more in terms of margin of safety versus my calculation. I'm around at 20 to 25% discount versus the current, so the intrinsic value versus the current share price. So for me, the current share price is 20 to 25% below its intrinsic value. For Morningstar, it's nearly 39%, which is a lot, but okay. And they consider that the fair value of the company is 112, where VingeGPT considers that the fair value is somewhere between 75 and 85 US dollars at current earnings, of course. Right, so as a conclusion, I mean, I already made the conclusion. I'm showing you here also an advertising of Converse. So those shoes that are very well known by young people, by teenagers as well. So I'd like to thank you for your attention. I hope that this analysis of Nike was interesting and that you understand, and again, by sharing this type of videos, that you understand how I analyze those companies. But you see, I think if there is one recommendation is you have to read the financial reports. And of course, you have to understand the business that the company is in and the strategy and what is going on, and not just looking at Nike only as a graph on a stock market. So I think that it is important. That's a reason why I stay away from some industries that I do not understand. With that, thanks for your attention, and I hope you liked the video, and talk to you in the next one. Thank you.